listening to Inside Real Estate, your source for all things mortgage and real estate related. The show that brings you all the hottest topics and insights directly from those who know it most. Now sit back and enjoy the show.
Yes, sit back and enjoy the show. Paul Apostolakis, how is everybody doing today? We have a very special guest today. I'm looking forward to speaking to them. First and foremost, for all of you that are tuning in, thank you for tuning in. Go to irepodcast.com. You can go to Facebook.com/IRE Podcast to see us live. We do have a new podcast studio, so bear with us as we're starting to, we're doing some different things, but we're trying to get this thing working properly. So first and foremost, obviously in our market right now, we're seeing a lot of shifts, and it's crazy what's happening. We're having a lot of mortgage companies lay people off with high interest rates. So it's an interesting time in real estate right now, wouldn't you say?
I'm sorry, Paul, was that a question for me?
Yes, that's for you.
Okay. Yeah, I would. Actually, the last few years have had their own different aspects that have been challenging. But right now, prices are extremely high. And I can certainly speak to pricing in the multifamily sector.
Right.
We also have a sister company that invests in commercial property, specializing in suburban office primarily and suburban light industrial or logistics. And prices are high. And whenever prices get high, it very generally means returns are low. Prices are measured against the net income. So prices are very high. And notwithstanding that, interest rates are moving up too. So usually there's a little something of an inverse correlation between the two, but right now they're both high, which creates challenges because you've got to bid against other people that are qualified, that have capital, that know how to execute. So you got to pay dear. And then if you use financing, which we do, I consider us an intermediate leverage shop. If you use financing, which we do, it further stresses the returns. So yeah, it's very competitive, and the lending environment is making it even more competitive.
Yeah. So Mark, why don't you give the audience a little bit of background on you? How did you get into the business to start off with?
Well, my story is a bit of a misadventure that worked out. I stumbled into a commercial real estate shop a very long time ago, when you were probably not even a gleam in your father's eye, or a twinkle in your father's eye, as my mother might say. But I got the bug. This was in the early 80s. I got the bug, and I thought I was going into the literary world, and that didn't work out so well, but it seems like this real estate thing might still. So, I've been at it 41 years. I've been through a few cycles. I've been through a few different manifestations of being an operator. Started small. And after 20 years, I met a fellow named Tony Zanze, who had a very institutional background. Mine was more of a local operator background. And we hit it off, right? That was 2001. But we were still small. We were a total of 3 people. I had probably 400 units under my belt at the time. He had about 60 units under his belt at the time. And we just linked up and went all in. And every year we're able to do a little bit more. We've always been a friends and family shop in terms of the investment capital that we raise. As an organization, we're our own biggest investor. But we also have about 1,500 accredited investors, most of whom we know personally. We also run at any given time. We've run with 10 to 12 institutional partners. We run with some family offices and high net worth investors, and generally take every opportunity as a unique assignment in terms of putting the capital structure together. But Tony's and my first acquisition was in 2001. It was 16 units. Last year, we closed about $1.1 billion in acquisitions in apartments. It's hard to know what this year will be like, but it could be, we might exceed that number because we have a significant amount of property, of our own property that we're selling, through our partnerships.
Sure.
And almost universally, when we sell, we turn around and buy. We favor the 1031 exchange. We know how to use it. We believe that it's not only good for after-tax yield production, but we also believe it's good for the economy. And we've studied that. We co-authored a research paper with CBRE. It's been a long-term gig. It will continue to be a long-term gig. We've grown from 3 people to about 65 people.
Wow.
We've grown from principally one market, the Bay Area market, although that was both San Francisco and Oakland. And now we're in 27 markets in 17 states. And we didn't set out to be nationwide, and I wouldn't quite say we're nationwide, but we're in all the time zones except Hawaii and Alaska. And we're just ferocious about looking for yield. And so we turn over rocks everywhere we can.
Just always looking for yield. That's interesting. What do you see as some of the biggest hurdles going into this year compared or the last few years have been really robust, low interest rates, really wind at your back type environment, and now it's really shifted into wind in your face. When the wind was at your back, obviously what were you looking for in comparison to today, where now things are kind of shifted?
That's a really good question. I would say that let's just break it down to the last 20 years. It's actually today, this is our 21st year. So over the first lengthy period, we were really what I would call a growth and income shop. We always look for growth first and income second. We look for things that we thought were measurably undervalued,
Right.
that presented the opportunity to drive the value. Our industry refers to that as value add, and that could be any blend of rolling up your sleeves on the management, doing significant capex, capital improvements and the like, rebooting the tenant profile, just anything you need to do to make it to make the asset more mainstream, to make the asset more attractive. So, but growth was always the focus, and I think in our first 10 years, certainly in the first 5 years, we didn't own things very long. We might own things for 2 to 3 years. We'd run our value add campaign and reboot it and sell it to somebody else who wanted it, who liked it, and then go out and buy something else. So at the end of about 10 years, our average hold period was probably 42 months, so 3.5 years. Since then, things have lengthened out, and I think our average hold now is somewhere between 6 and 7 years. And what that really means is the average hold for the properties that we've purchased over the last 10 years is much more likely to be at least 7 to 10 years. We have properties that we will own longer than 10. But duration is long. And so with that saying, we've become more of an income and growth shop, income first, but we don't want to do anything that we think won't also have growth. So, that characterizes our shift. And so, we're looking for, we really have to insist on things that give us better than ordinary cash flow. And cash flow right now is low, and still some good argument for growth. And sometimes the growth will come because an asset maybe hasn't been well enough taken care of. The owner has perhaps been absent or distracted. Growth may also come from local economies, whether it's Nashville or Austin or Colorado or Denver. There are economies where they're growing jobs and growing wages, and generally when there's some restraint on or challenges for delivering multifamily, when multifamily deliveries aren't gonna take off and just bury you in new apartments, when there's some restraint on the delivery of new units and you have job growth, you usually get income growth, especially if they're good jobs. Sure. So more and more we're expecting growth to come from the markets that we're in. It's very hard to find stuff that's unloved. There's so much capital out there right now that, again, what we call value add, is being just ferociously upbid. But we have business we need to do. We have our own exchanges we need to complete. We need to complete exchanges for clients who bring in an exchange requirement. And so we're at it every day. Our transactions team is 8 people. Started out, 2003. Our transactions team was 1 person. And it's a business that keeps you busy. And we have great people in the shop. And so the challenge for us this year is finding yield, notwithstanding high prices and high interest rates.
Right. So, and you feel that that's still that you'll still be able to find yield in select markets, but some markets are probably out of the market not right now for you to be entering. It's more pocketed.
Yeah. Paul, you raise a really interesting point. We're in 27 or 28 markets. There are really none of those markets that we won't go into. We like them all, right? We vetted them. We have assets there. We like what we're doing there. We like what our management partners are doing. And so, we don't have any no-fly zones in terms of the markets. However, there are markets where it's extremely hard to buy right now because of pricing. And so whether that's Seattle or Phoenix or the Bay Area or Austin, Texas, it's really, really hard to underwrite income. And so there are in those markets, we're selling. We're selling in the Northwest. We are also, at any given time, we may be selling in Colorado and Utah. At one point in time, we had 13 properties in metropolitan Salt Lake. Today, we're down to 3. At one point, we had a couple of dozen properties in Texas, and today we're probably down to a half dozen. So where we think conditions have just peaked, and we think the return on the investor capital may have challenges going forward from the peak, we will generally, we favor selling into strength. And then looking for places where we can buy, I don't want to say into weakness because it's hard to find that, but buy into places where there's still a rosy path ahead.
Yeah, I was going to ask, what triggers a sale, right? What is it that says, okay, this property needs to be sold now, as opposed to let's hold on to it for a few more years and see if we can get some more cash flow out of it?
Really good question. And so, in my opinion, if you look at people who have been terrifically successful as real estate investors, they use leverage. They use it judiciously, but they use leverage. And, in case anybody that doesn't necessarily know what leverage means, if you're going to buy a $10 million property and you put a 70% loan on it, you're 70% levered.
Right.
And that means that your investment capital was $3 million. The ownership is concentrated in that $3 million. It's not concentrated in the 7. And so if you can increase the value of the real estate to, let's say you can increase the value of the real estate to $13 million, you're going to have costs on both your buy side and your sell side, but setting that aside for the time being. You've doubled your money, right? You put in $3 million, you get out 6. And so that leverage piece, the lender piece, all they want is a reliable income stream. They want timely payments, security. They want a good borrower, and they want the timely payments of their financing. So, judicious leverage concentrates the benefit of the ownership, the return benefits of the ownership into the equity position. And so, we favor that. We're typically an intermediate leverage borrower, and I realize I've kind of gotten off topic here. You're probably going to have to bring me back.
It's okay.
But we favor judicious leverage. It's hard to get much leverage right now because interest rates are high, so that's bringing proceeds back. But you're going to have to reprompt me with the question, Paul, because I've completely lost track.
No, it's okay. No, my whole thing is when do you pull the trigger?
So if we've gotten to a point where the property's worth, same scenario, $10 million purchase, we've gotten to a point where the property's worth $15 million, we're going to sell. I mean, we start out, I mean, we might even sell at $13 million. In fact, we probably would. We're going to start out, we do our best to model financial performance for 5 years. And I don't want to say it's going to be arbitrary, but it's a model, right? It indicates the conclusions that we've drawn. We will document our transactions for a 10-year business plan. And we generally put 10-year financing on them, 10-year fixed rate debt. We would rather guard our downside and hedge our interest rate risk with fixed rate loans than use variable. There are benefits in going variable, but we're typically a fixed rate borrower. Sure. So let's just pretend that we had a business plan for 7 to 10 years, a pro forma for 5, 10-year loan, and we've gotten in year 4, we've gotten to a point where we've got that $13 million sale. Again, we put in $3 million, $7 million loan, $10 million purchase price, and now we think we can clear $13 million. We're going to sell that. We're not going to wait for, I like to refer to it as putting a 5th quarter on the clock. You've won the game. It's the NBA Finals. You've won. Game 7, you've won. You don't decide to put a 5th quarter on the clock just to play something because it's fun, right? Mission
Great
accomplished.
analogy.
Yeah, we tend to sell into strength. But exceptions to that would be that if we finished our business plan, and it's been a great ride, and we look at the playing field for rates of return, and think that we're not necessarily, and think that we have more long-term upside in the asset that we have than what we can find in the market, we'll reboot, we'll refinance. Generally speaking, we're going to return a significant amount of capital at the loan maturity. We have a number of properties where we've been able to return all of the capital anywhere between year 5 and year 10. And if that still has upside in our measurement, we'll reboot, we'll do a second stage business plan, we'll refinance it, and we'll carry on. Again, we'll return as much capital as we can through refinancing. And so probably 9 times out of 10, we're going to sell, but there are those instances where we think the asset and its future has as much upside as it did when we bought it. And in those instances, we'll refinance it, return capital, continue to make distributions to the investors and ourselves, and double down for another 10 years.
It sounds like you have a very not conservative but safe mindset where you're protecting yourself at all costs. You don't want to make sure you're not stretching the company or your financial position too thin.
Yeah, you're right about that. And I don't know that we're ideologically conservative. We're certainly conservative as investors. We want to make sure the capital's there and that it's well invested and that it's protected. But I call it the MotherInLaw Test. Does what you're doing pass the MotherInLaw Test? And I use that expression because my wife's mother, who was an investor with us for a long time, she's passed now, and was no wallflower, right? She was savvy. How do I explain something to her if it's gone bad? Right. And, does it pass the MotherInLaw Test? So I would probably say that we're opportunistic first, commonsensical second, but we certainly want to defend against downside scenarios and against unintended consequences. And, unintended consequences are around us every day, all of us. And so we try to guard against that. We're very good at risk management. We're very good at asset management. We're very good at capital markets, and probably in our second or third year, we had been variable rate borrowers, but probably in our second or third year, we shifted to fixed rate borrowers so that we knew that we were capitating interest rate costs, and for us, the only real downside with a fixed rate loan is that if you want to pay it off early, you're gonna pay a prepayment penalty. And if rates are significantly lower than they were when you originated the debt, the prepayment penalty could be significant. And so that could be an impediment to selling when you want to sell. But we tend to be agnostic about prepayment penalties. It's we get the benefit when we take out the debt, we get what we seek. And we guard against upward movement in interest rates, which we're having right now. And if there's a prepayment penalty, well, that's just a fact of life. And if we want to sell, we're just going to look at our net. Where are we net of prepayment costs? And if we're still hitting it out of the park, I think you really have to be agnostic about it. We have clients sometimes who wonder about that. But the answer is, are you sure that things are going to be as strong in 5 years when our interest rate, when our loan comes due and we can pay it off without penalty? How sure are you that things are going to be even better, right? You can't make that bet. Things change every year. And if you make your measurements in real time and you swallow the prepayment penalty and you go out and find something else that you like and you lock in low rates, then you've moved that, despite paying the prepayment penalty, you've moved that investor group to what I would say is even a more favorable interest rate position. So we will, we concentrate on the multiple. Are we making the money that we want to make? And if we can guard, if we look for guardrails, whether it's our risk platform or our borrowing platform, we look for guardrails so that we can really focus on operating and driving net income. And we're very good at doing that.
That's awesome. That's really awesome. I know you mentioned you've got a team, a large team now, 70 or 65, forget what the number was exactly, but it's a large team. How do you manage all those people while also trying to stay on course?
Well, I mean, the good answer to that is I don't. I'm kind of, I don't want to say, I'm a little bit of a 30,000 foot guy.
Yeah.
I'm a big picture guy.
Yeah.
And I'm also very good at getting down under 3 feet. So if it's closer than 3 feet or further out than 10,000 feet, I'm really good at my job. When I have to be in the middle and do a lot of management, I'm not as strong as that. But we built a team with really great leadership. We just promoted our president and chief investment officer to CEO. I'm not going out to pasture just yet. I figure I got another 10 years on me. Okay. I'm in more of a co-chair role, which is really more of a title than anything. Yeah. We all have groups that we run, and my groups are the same. And in terms of managing them, I make sure that I understand what I and my teams are focusing on, what the areas are that we're focusing on, and then I'm getting progress. And we might have weekly meetings, we might have monthly meetings, we might have quarterly meetings. And my job is to really just see if we're on course, right? To see if we're moving along on the things that we're working on. And I think that's probably the overall managerial ethos of the organization, is that everybody in the organization wants to be on a good team. The leaders want to have good teams under them. They want to make sure that people understand their work and understand our deadlines, and we're making progress toward our deadlines. But I would say, I don't want to say management in our world takes care of itself. It doesn't. But I think the leaders in the organization are more advisors, spiritual counselors, gurus, call it what you want, allies, right? We have a very flat organization, and we've been lucky to get great people. And I mentioned that we promoted our president to CEO. We also promoted 6 managing directors into partners.
That's awesome.
So I would just say that if you get great people and you make sure that everybody understands their work, and you create a nice long-term upside path for people, a lot of the drive to do the work will take the place of management.
Yeah, for sure. I always think it's interesting when there's an organization that large and you have a sophisticated process and product like you have. I mean, it's really sophisticated stuff that you're doing. It makes it, I think, challenging to find and have a group that's large enough that's going to be able to handle that in a succinct way. So that's kudos to you for building that. That's really awesome.
Well, I think the other part of the ethos of the shop is everybody's pretty much all in. We don't send people home at the end of the day spent and burned out. We try to use care to make sure that people are living great lives, not just doing great work. But I will say that getting great people is the big difference maker, and creating transparency and giving people a fair shake and an upside path has a really effective way of solving problems.
Yeah. Where is the company going today? I mean, where do you see your company going today and into the future?
That's a good question. So I used to think of us, well, in fact, I've even called us a backyard syndicator. We were three people. We were making phone calls, finding things, going hucklebuck to do deals. And that evolved. But I would say for the first 5 years, for sure, we were very much a run and gun shop, just going hell's bells to get the things that we could get and doing our best with them and just flailing at it. As you get older, you probably implement processes. You're more prone to thinking about workflow, right? And so we're really not. People have laughed. We have almost 25,000 apartments, and so people will sometimes laugh when I call us an overgrown backyard syndicator, because we're really not that anymore. But I'd say we have institutional practices, and certainly produce institutional results or better. And I think in many ways we're becoming more of a small institution. I don't know that we'll ever be a big institution. We've put a lot of work into long-term planning and succession planning in the last 4 years, and I feel really good about that. But I just, first of all, I believe that we're going to be an organization that's going to be around, that we've rebuilt ourselves for the next 20 years. I really do believe that. And we've got people inside the walls of the organization who I know are just absolutely capable of mastering that. So I think we're going to be more long-term. I mean, we are more long-term. We're planning for longer-term executions on our transactions. We're investing in staff. We're adopting more institutional practices, like auditing and institutional risk management and institutional cyber management and all that kind of stuff.
Right.
We've added 3 attorneys to our in-house staff. We added our first attorney 8 years ago. And so I think that we're not going to become hidebound and rigid. I think we'll always be a flat organization. But I think that if the word institutional applies, I think that we've achieved and will continue to achieve a level of meticulousness on all the aspects of our operation, and that we're able to be more proactive, right, instead of reactive. But I do believe that we're going to continue to be long-term. We'll continue to grow incrementally. We will continue to onboard new investors. We don't use broker dealers. I doubt we ever will. We operate, back in the day, we used to refer to Regulation D of the Securities Act of 1933, which says you can basically sell securities, which these are, to investors, provided that you have, quote unquote, a prior business relationship with them. And what that just means is you have to know them, and you have to cultivate a relationship with them. You don't pick up the phone and try to sell a stranger something on the first day. And we spend weeks, months, and sometimes years getting to know people, and we're never in any particular rush about it. But over the next 10 years, I think our investor group might double. I think we'll continue to be more institutional, both in our practices and with our investors. We've done a number of small funds, which we call identified funds, because we can identify the assets that are going into them before we securitize them and subscribe them. We also just did our first discretionary fund. We have always been kind of a tenant in common exchange sponsor. We're moving more toward a Delaware statutory trust execution format and a separate account format. But I think in the long run, we're gonna build ourselves so that we can do our jobs well and produce not only good results, but terrific care for what we do.
I love that. In an environment where a lot of real estate businesses are either laying off or kind of skimming the fat, you're in a position where you can actually hire, which is awesome.
So
It's a
it's
really
going to be
awesome testament.
interesting. There's a gentleman named Barry Sternlicht who runs Starwood Capital. And he's one of his expressions is words to the effect of, when the tide gets really high, you get a lot of Johnny come latelys who are going to come into the market
Yeah.
and think they can do it too. And I've known this for 40 years. I believe the term that he uses to describe these people is tourists. And so, there are a lot of tourists in the market right now. And it's easy to find one deal. It's easy to find, well, it's not easy. It's easier to find one deal or three or five, but to do it every year, year in, year out, you have to be very dispassionate about the returns that you're looking at. You have to, in fact, you have to be willing to be your own biggest critic, right? You have to really be cranky as an underwriter, and you have to believe that you've identified all the downside exposures and all the costs, and you're not euphemizing anything. And I do think that there are a lot of young sponsors out there who've gone out and found things that look good and may end up being insanely good. But I also think that a lot of those people are using relatively high leverage, and I think a very large number of those people have used variable debt. So we'll see what kind of pain comes into the market for people who've levered high, who are young in their professional life, and who have used variable rate debt. That's going to be interesting to see.
Does that bode well for a company like you when there are tourists in the market, like you said, that might be making bad decisions? Is that an opportunity for a company like you?
Well, it's an opportunity for sure if there's a shakeout.
Right.
Every year for the last 11 years, from 2011 forward, there's been more and more capital in the market. There's been more and more practitioners in the market. And I don't have any great concern about practitioners. People should do what they want, right? We'll do our best. We know what our work is. We will do our best to get the results that we want. And as a general matter, we're buying more core plus right now rather than value add. And core plus means it's good real estate. It's well located. It may not have quite the amount of upside that you would expect from a project. And you anticipate it being more of a stable, long-term income play. And so, we just have to do the underwriting. Is the underwriting going to get us there? Then we go forward. If it's not, then we don't go forward. And so I think with the core plus, especially, you don't see a lot of newcomers going after core plus. Because it's just not where you can make it sizzle. Where you can make it sizzle if you're a new investor and you want to knock the lights out is something that's value add. And value add's really hard right now. So I honestly don't, we're pretty much agnostic about the number of players in the market. And the number of players in the market and the high pricing helps us on the sell side, right? So there's room for everybody. I do think that the any sort of winding back of capital appetite or diminishment of capital appetite will cause returns to come up a bit, and that would be a good thing. It would make our jobs easier as buyers. It may not give us quite the yields that we could get as sellers, but right now, if you're a seller, yields are very high. Your appreciation and your equity growth is going to be really high, and we have a number of assets that we're selling right now that we're way overshooting our marks. And so it's good to have buyers out there.
Yeah. Yeah. You need to have the buyers out there, right? To
Yep.
keep the whole thing moving.
Yep.
Yeah. That's awesome. That's really awesome. So, going into this next year, do you see any policy changes coming down the pike that could cause some rifts in your or challenges for your endeavors?
Well, the Fed, everybody's spotlight, everybody's eyes are on the Fed right now,
Right.
because we have inflation and interest rate movement. And I don't think there's any question, but that the Fed is going to keep raising rates. The stock
Agreed.
market believes that. That's priced into the stock market has priced that in.
Sure.
And so, from a policy standpoint, that's policy. Monetary policy is policy. So I expect the Fed will continue to do its job. I looked at a report the other day from the National Multifamily Housing Council, which is an industry group, very important industry group, and the forecast that I looked at anticipated a spike in inflation at about 8%, 8 to 8.5%, and I think we're basically there, right? I think we're there, and so in this analysis, there's maybe not that much more pain to go through in terms of the inflation side. And I'm sure I don't recall exactly what they were pegging for short-term interest rates. But the Fed is arguably, depending on how the economy does, the Fed has got at least 100 basis points of room to run in terms of raising short-term rates. Right now, the 10-year bond is still below 3. We all expect the 10-year bond will go up to 3. The 10-year bond is what really sets the kind of is what sets the rate for the kind of borrowing that we do, and we're usually going to borrow, anywhere from, depending on market demand, we're going to borrow anywhere from 125 to 225 basis points above the 10-year bond. But I think that the center of the target for that is probably 150 basis points. So if the 10-year bond gets to 3, we're going to borrow at 4.5. And that again, that brings down your yields, right? It makes it a little more challenging. So on the policy side, I think we obviously anticipate interest rate movement, and some of that's also just market based. But the Fed is instrumental as either a participant or a watchdog on monetary policy and inflation. So there'll be plenty of that. In terms of regulation, real estate's a local business. It's state-based. State statutes really govern most real estate activity. There are certain national statutes, but the national stuff is basically anti-discrimination and tax. I don't foresee any changes on the tax side. Every once in a while, people trot out the 1031 exchange. It's a favorite whipping boy for people in Washington D.C. who I believe do not understand it. Right. We've really looked closely at it, and the 1031 exchange was in the crosshairs in Biden's first economic plan. The industry was able to convince Washington D.C. that the 1031 exchange, in fact, is not a loophole, that it plays a very important part in driving the national economy. But it's bubbled up again. 1031 is making an attempt to at least be on the table. I won't speculate on probability of an elimination of the 1031.
Right.
The industry doesn't seem to think it's very likely. And we've authored a paper that's available. Anybody can get it just by looking it up. It's words to the effect of 10 benefits of the 1031 exchange from Hamilton Zanze. That'll probably take you there. We also created a very short video, animated video that's easy to take on the role that the 1031 plays in driving the national economy. So that remains to be seen. But I would say those are the only two things that I can think of from the standpoint of policy or regulation.
Yeah, that's awesome. So we're running low on time. We do this thing called 3 questions at the end of the show. They're really random, 3 questions. So we're going to hit you with them and then we'll let you go. And I do appreciate your time greatly. I mean, it's been really good, riveting stuff talking about all that you do. But let's go into the 3 questions. If you could eat one food for the rest of your life, what would it be and why?
Wow. Tacos. Because tacos are good. Tacos are good.
Tacos are good. Tacos are really good. All right. If you could go back to one era in time, 80s, 50s, 40s, 90s, whatever it may be, which era, which decade would you go back to?
Where am I?
You're here today.
Okay. So in the United States today,
Yeah.
in my home environment, what era would I go back to?
Yeah.
I'd go back to the early 90s with a suitcase full of cash. Because we know a lot more than we knew 30 years ago.
Yes.
Myself and my partners and our investors. And the early 90s, Congress cleaned up the wreckage of the savings and loan fiasco
Right.
by creating something called the Resolution Trust Corp, also known as the RTC. And the RTC just came in. It was a blunt instrument. They came in, they closed down savings and loans. They took the assets, they put them on the back, they put the assets on the balance sheet of the taxpayer inside this thing called the Resolution Trust Corp. And their job was just to clean house.
Yeah.
They didn't have any interest in being patient about it. They wanted to get the fiasco behind them. And so there had been a lot of overdevelopment in the late 80s because of the tax rules of the early 80s and the lending rules of the 80s. And so there used to be what we would call a see-through building. It's a beautiful high-rise in Houston that doesn't have a single tenant in it. And
Right.
that's what it was called, a see-through building. But there was also overbuilding of apartments, but maybe not so much. But a lot of great investors, Barry Sternlicht at Starwood, Sam Zell at Equity Residential, built war chests and went out and bought stuff from the RTC and did really well with that. So I'd have to say the early 90s.
That's awesome. So totally for financial gain.
Yeah, completely.
That's awesome. What was my last question I had for you? If you could change one thing about your business today, what would it be?
Wow, that's a great question. What would it be? Wow, that's tough. Because we're really built pretty well, and I think that we have. I think they have the teams and the people that we want. We have a couple of different investment platforms. We have a lending platform. We have a insurance platform. We have two management companies. And I would just say, if I was going to change one thing, I'll give you one. If you're in real estate, I think you're at least a closet developer. I think anybody who's caught the real estate bug really just believes that they should be a developer.
Yeah.
And so we have a lot of development experience. We've done a lot of very heavy lifting on our properties. We know how to build things, but we've never taken a piece of dirt out and made it into an apartment community. And I think that's coming for us. I think that we will ease into that business. We've been around it and been in parts of it. I think that's coming for us. And I would just say that I'm looking forward to see where our development aspirations may be in terms of fruition 3 to 5 years from now. But that's really the only thing I can think of.
That's awesome. That's perfect. You've got a good business then. That's all you can think of.
You've been lucky. You have really great people.
I don't think luck has a lot to do with it. You probably have a lot of skill in there.
Well, I tell you, we do our jobs well. We're a preferred buyer from many institutions because they know we're going to close. We've been in contract on apartments, close to buy apartments, probably close to 275 times in the last 20 years. And the number of deals that we tied up that we didn't close is very, very small. It might be 5 or 6 deals. But we have the reputation that we have because we're hard on ourselves. Underwriting isn't easy. We really demand the returns, or we pass, and
Right.
and we can still keep deal flow going because we're in a number of markets. But we certainly have our bona fides. We're good at our work, but you can't discount luck. Luck plays a part, or let's just say circumstance or opportunity plays a part in all of our lives. And circumstance and opportunity has been a big part, big factor in my life. And my life is better for it.
I love it. I love it. Well, listen, man, thank you so much for doing the show. Imparting your knowledge on us. It means a lot to the audience and you coming on. So really appreciate it.
You bet. I've enjoyed it, and I hope we have a chance to talk again.
Absolutely, sir. Absolutely, sir. Good day, and take care of yourself.
Thanks, Paul.
No problem, sir. Have a good one. That was interesting, Natalia, right? Natalia, can you talk to us now or no?
Very. He's very intelligent in this space.
Super well spoken, right?
For sure, definitely. And very easy to understand too.
What do you think of the new podcast, Ro?
I like it. And then I can see, like, if Tom is on, you could switch to him, you, and both of you.
Mm-hmm. Yeah.
Be sweet.
It'll be good. It'll get better. But can you hear me okay now?
Yeah, I can hear you just fine through that.
Got it. All right. Well, thank you all for listening. Those of you that made it through this show, I appreciate it. Please go to irepodcast.com, Facebook.com/IRE podcast, or anywhere that you listen to podcasts. We'll be there. Until next week, we will see you then. Thank you so much.
See ya.
You've been listening to Inside Real Estate, the nation's top real estate podcast. Don't forget to follow us at irepodcast.com and everywhere where podcasts are available.